Okay, let's unpack this. You hear so much about AI these days, right? And well, companies like SoundHound AI are right in the thick of it. The market's constantly buzzing, new developments, valuation shifting, and honestly, it can be genuinely tough to figure out what's really going on under all the headlines and, the investor chatter. So today we're doing a deep dive into SoundHound AI. The ticker is SOUN. It's a company that sits right at that intersection of cutting edge voice AI tech and the often pretty volatile stock market. Our mission here is really to boil down the core insights from the financial analysis we've looked at. We want to help you understand the key arguments both for and maybe against investing in SoundHound and really what makes this company unique in the current climate.
Yeah, it's a fascinating case, truly, because what you have here is a company with tech that absolutely captures the imagination. Hold out this promise of what AI can really do. But then, when you look at the financial picture, it presents a real puzzle, a definite puzzle. We'll be exploring that tension today, looking at how the market is valuing this huge future potential against its very real present financial reality. It's kind of a classic innovator's dilemma, really, but seen right through the lens of its stock price and financials.
Exactly. So let's jump straight into the numbers that, kind of grab your attention first. Our sources point out this immediate sticker shock. SoundHound AI is currently trading at a really, really lofty 38 times its trailing sales. And just quickly, trailing sales, that's just the company's revenue over the last 12 months.
Yeah.
So its market value is 38 times higher than what it brought in over the past year, which is a lot. And maybe even more striking, the company is still deeply unprofitable. As of August 22nd, 2025, the stock was around $12.56, giving it this hefty $5 billion market cap. The analysts we're looking at pointed out that the stock is basically priced for perfection, meaning, the market's expecting flawless execution, massive growth, no hiccups. They even mentioned a meme stock surge back in December 2024, which for a bit saw its valuation driven more by social media buzz than the underlying financials. So that gives some context for today's price too.
Right. And when we see a stock trading at 38 times trailing revenue, particularly when it's unprofitable, well, that sends a very clear signal, doesn't it? The market is betting heavily, heavily on future growth, not what's happening right now. A valuation this high for a company that isn't yet making money, it indicates extreme optimism. Yes, extreme. So the critical question becomes, what exactly is fueling that kind of conviction, that level of belief? And when we say unprofitable, what does that mean practically? It means it's total costs, running the business, developing the tech, everything. It consistently exceeds the money it brings in from sales. It's spending more than it earns. Now, that can be pretty common for high growth tech companies focused on grabbing market share, but, well, it undeniably carries significant risks for anyone investing.
And that unprofitability, it's not just like an accounting thing on paper, right? Our source details an operating loss get the $78 million in just the second quarter of 2025. And that's against only $42.7 million in top-line revenues for that same period. So losing almost twice what they made. And crucially, like you said, this isn't just paper losses from, say, depreciation, stuff that doesn't involve actual money leaving the bank. No, the company is quite literally burning actual cash. Operating cash flow was a negative $18.5 million. But what does that actually mean for keeping the lights on? How do they fund everything? Well, they're mainly doing it by selling new shares of their stock while the price is high. It's a common strategy for growth companies, sure, but it has a very direct impact on existing shareholders. Our sources show the diluted share count, basically the total number of shares out there, rose by 21% over the last year, which for someone already holding the stock, that essentially waters down your potential returns by about that same percentage. Your slice gets smaller.
And this is where things get really interesting for an investor, because it raises that critical question you just touched on. If I'm holding shares, I'm seeing my potential future earnings diluted. My piece of the company pie is shrinking percentage-wise, even if the whole company is growing. So is there any scenario where this level of dilution isn't a major red flag?
Especially with negative cash flow.
That's a great question. I mean, how do companies usually justify that? Or maybe how does the market typically react? Do they just accept it? Well, often, yes, the market does accept it, particularly for companies in these really hot, high-growth sectors like AI. And the justification is precisely because it allows the company to build up what they call a robust cash reserve. This cash is vital. It gives them the capital for R&D, for expanding operations, maybe for strategic acquisitions, things they couldn't afford otherwise. So while dilution definitely means your ownership stake shrinks relative to the total number of shares, the argument is that this big cash injection lets the company grow much faster. And ultimately, the idea is that your smaller piece of a much, much larger, more valuable company will be worth more than a bigger piece of a company that's stagnant or shrinking. It's a gamble, really, a gamble on future scale. You're hoping today's dilution pays off with tomorrow's huge growth. Understanding that trade-off is just crucial for thinking critically about a company's financial health and, the long-term value for shareholders.
Okay, so after all that talk about burning cash and dilution, you might be sitting there wondering, is there any good reason to even look at SoundHound? And this is where the story takes a really sharp turn, because despite those financial hurdles we just discussed, the company is growing. And not just growing, growing at a truly blistering pace. Our sources show second quarter revenues more than tripled year over year. Tripled. That kind of acceleration tells you something about their market impact, right? Demand for their products seems strong. It also helps explain why some of those expenses are just skyrocketing. The soaring administrative costs, the jump in cost of revenues, which went from $5 million to $26 million, and sales and marketing expenses nearly tripled too. These are all cited as essentially necessary increases for a company expanding this aggressively. And thanks to that cash, they raised that combo of high share prices and selling lots of new stock. SoundHound AI can now afford things like partnerships, acquisitions, big product development projects that were simply out of reach before.
Right. And what's fascinating here, from a strategic perspective, is that while the current financials, yeah, they definitely look challenging, the company is making a very deliberate choice. You can see it. They are investing heavily, really doubling down on their future, on their tech, on their market position. This aggressive growth strategy, it suggests a really strong belief internally in their product and its potential to grab a big slice of the AI voice market. They're clearly prioritizing rapid expansion and development over getting profitable right now. They're banking on a much bigger payoff down the line once they've hopefully established a dominant, maybe even unassailable position.
But couldn't you also argue the flip side? That maybe such fast expansion and spending, given they're still losing money, could that signal maybe a desperate race? Trying to grab market share before serious competitors really catch up or emerge? What's the counter to that aggressive belief?
Well, that's an entirely valid perspective. Absolutely. In a field like AI that's moving so incredibly fast, the window to establish market leadership can be really short. So, aggressive spending might indeed be partly defensive, trying to outrun potential rivals. And if that strategy doesn't pay off, well, the financial consequences could be pretty severe. The counter-argument, though, often comes back to concepts like network effects or first-mover advantage. The idea is, if SoundHound can get its AI embedded into enough products and services early on, it could create high switching costs for its customers. Plus, they amass all this valuable data that makes their AI even smarter, creating this positive feedback loop that's hard for competitors to break into later. That's the optimistic view, anyway. Yeah.
That this big, costly investment now builds an insurmountable lead for the future.
That makes sense. Okay, and when we talk about the actual source of this growth, the meat and potatoes of SoundHound's rising revenue, our source highlights that most of these soaring sales aren't just one-time deals. They're tied to long-term service agreements or subscription-style contracts, so potentially recurring revenue. The company used to report something called order bookings every quarter, and the last time they did, at the end of 2024, they reported a significant $1.2 billion in unfilled long-term contracts. That's future revenue locked in, basically. Now, management says they'll report this annually going forward, apparently because it can be volatile quarter to quarter, but still that backlog is a really crucial indicator.
Yes, it is. And stepping back to look at the bigger picture, the market implications, including this pile of future revenue that's already contracted, it definitely makes SoundHound AI stock look, well, more palatable, as the analysts put it. Think about it. With that $5 billion market cap today, if you compare it to that $1.2 billion backlog, the stock trades at roughly 4.2 times that backlog balance. Now, that is a very different number than the 38 times trailing sales we started with, isn't it? It just clearly shows how looking at different valuation metrics, past performance versus contracted future revenue, can paint completely different pictures of a company's value. It really depends on which lens you choose to use. It underscores why you need a holistic view.
Right. It's all about that long-term vision versus the present reality. And let's try to make this tech more concrete. Imagine ordering a really complex coffee at a drive-thru, right? And the AI just gets it perfectly, even with music playing in your car. Or think about your car's voice system seamlessly understanding everything: navigation, climate control, music, just by you talking naturally. SoundHound's AI is actually making these things happen. For car makers, for those drive-through services, which are getting more common, for complex phone menu systems, this isn't just theory. It's being deployed in pretty significant target markets right now. And when you look at those applications, yeah, it's easy to paint a picture of huge long-term potential. I mean, I can definitely imagine this company growing into a major tech player, becoming almost indispensable in how we interact with technology daily.
But, and there's always a but with these high-growth stories, isn't there? For every exciting vision of growth, there's that flip side, that critical question. What could actually derail this really ambitious journey? And, well, many things could go wrong in the meantime. Absolutely. That heavy stock dilution we talked about earlier, that remains a troublesome concern because it directly hits existing shareholders by spreading future earnings thinner and thinner. Beyond that, okay, SoundHound AI's tech is arguably top of the line today. But what if someone else, maybe one of the tech giants with deep pockets, or maybe a super agile startup develops an alternative that's just as good, or maybe even better? The competitive landscape in AI is just incredibly fierce. It's constantly changing. And that all-important order backlog we just discussed, well, it could potentially dry up if some hypothetical rival starts winning all the new business opportunities. We're talking about a field where innovation is relentless, and serious competitive threats can emerge really, really quickly. This kind of evolution, becoming a true tech giant, that could take many, many years.
And those years are packed with risk, demanding constant investment and nonstop innovation just to stay ahead.
So putting it all together, the explosive potential versus the very real financial burn, the dilution, the competitive threats, what was the analyst's personal takeaway from our source material? Well, they stated it pretty simply. I'm not selling my existing shares, but I'm not reaching for the buy button either.
Nice.
So essentially, right now, SoundHound AI falls smack in the middle of that classic buy, hold, or sell decision. A hold. And it's also worth noting, just for another perspective, that the Motley Fool stock advisor service, they recently put out their list of 10 best stocks for investors to buy right now, and SoundHound AI was not on that list. So that offers a slightly different, maybe more cautious viewpoint from another well-known source.
Yeah, and ultimately, it really boils down to your personal appetite for unprofitable sales growth. That phrase kind of sums it up. It means you need to assess your own comfort level, right? With a potentially high-risk, high-reward situation, you have to balance that impressive future potential, that exciting tech, against the current financial realities, the losses, the cash burn, and those very real competitive risks we just discussed. It's about more than just crunching numbers. It's fundamentally about your perspective. How do you view innovation versus stability? And how much are you personally willing to bet on future success, knowing the path is uncertain? Are you the kind of investor who needs immediate returns and proven profitability, or are you willing to take on more risk for that chance, maybe a long shot, at exponential gains in a really cutting-edge field?
So there you have it, the two sides of SoundHound AI. You've got this company with truly explosive growth potential, really cutting-edge AI technology. But on the other hand, you have a steep valuation, significant ongoing unprofitability, and that persistent challenge of share dilution. It's a real balancing act, isn't it?
It really is. And this deep dive, I think, really highlights how these rapidly evolving tech companies, especially in AI, they force us all to reconsider the traditional ways we value stocks. Ultimately, what our exploration reveals is that SoundHound AI, right now, it feels less like a traditional investment and maybe more like a high-stakes wager on future dominance in the AI voice market. The critical insight for you, the listener. You're paying a significant premium today for growth that hasn't yet turned into profit. That demands a really clear-eyed view of both the massive opportunity and the inherent cash-burning risks involved. So maybe the provocative thought to leave you with is this. In this race, to find the next huge tech giant, how much of a premium are you really willing to pay for potential alone? Especially knowing that today's top of the line can face intense competition and a very uncertain future, perhaps very quickly.
Exactly. It definitely makes you think hard about how we value innovation itself, especially in a market moving at what feels like light speed. We definitely encourage you to keep exploring how that balance plays out, not just for SoundHound, but for other companies pushing the boundaries in this incredibly dynamic tech landscape.